This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
Well, in case you hadn't heard, there's a debt problem.
Oh, I have not heard that. Who's been talking about that?
I don't know if
Was
you
that
know.
on The View? No,
First
Sesame
of all,
Street.
Step one, never look at the national. What's the debt clock website that is just a space of fear and terror?
There
is it
several, but I think it's nationaldebtclock.org. So I was recently in New York City, and then I think I was off of 5th in Broadway, somewhere in that area, Broadway and something. And they have one of these right in the middle of the street. And it shows you,
calculator?
36, 20, 30, $37 trillion, whatever it is, right there. It's amazing.
That's
and
not
especially
okay.
with New Yorkers seeing that every day, it just amazes me. They see that and they're like, man, that's a lot of money. What are we going to do about that, Morty? I don't know. Go get a hot dog for a discount, maybe. I don't know. What are you going to do?
Here's the thing.
I'm just saying.
Here's the thing. The debt is real. It continues to grow.
Sure. Nobody
seems to be concerned about it, except for those of us who are going to have to pay it off, which
there
is
you go.
That's it. Every man and woman. This is Jon Hicks, founder of J. Hagan Capital, financial advisor. I'm Heather Branch here with Jon to ask him his ideas about what we can do to, I don't know if we can fully ignore the debt situation, but what we can do to try to put it out of our heads and control what we can control, which is how it will affect us, and then creating a plan so that it won't affect us, or at least won't affect us as much. This is the goal of the work that you do, Mr. Jonathan Hagan Hicks. And at J. Hagan Capital.
Oh, you used my whole name. That's like what my mom would do when I was in serious trouble.
It's official. At J. Hagan Capital.
Just for the record, I did not rack up all that debt. Just for the record,
okay,
I didn't do really much of any of that. Maybe none, actually.
At J. Hagan Capital, they are here to help answer your questions. We've got links posted in the show notes, so you can click there or visit us anytime at retirementsolutionshow.com. So I guess it depends on the source where you go. $36 trillion, $37 trillion in debt. Wherever you are, it's on the upward trajectory. Some estimate that the as you affectionately call it, Jon, the OBA, the One Big Beautiful Bill Act.
One Big Beautiful Bill Act. We'll see how beautiful it is in the long run.
Some estimate
they say it's going to be costly.
Another $2.4 trillion is what some estimate that it's going to put onto the deficit.
37 we got, right? So we're talking about closer to 40 trillion.
Mm-hmm. Quickly.
Well,
we'll quickly get there. So to fund our deficit, the U.S. Treasury sells bonds.
Sure.
One of the concerns right now is that fewer people and countries want to buy bonds because they think it's a risky investment. This is something actually I have thought about and I wanted to ask you before, Jon, but then I was afraid. I was like, I don't know if I feel like opening that can of worms up.
I think we have to.
Okay. Why would anybody buy are all bonds us giving money to the government? Or are there different kinds of bonds?
There's all kinds of bonds out there, right? So what we're talking about when we're talking about bond auctions and things like that, and what happens, when a country has this much debt, and we're seeing it, right? So right now, and here's one of those things, this is not one of those wonky things that we shouldn't be talking about. This is kind of a big deal for those that want to retire or that are already retired. And here's the reason why. Because not only did this get my attention, it's kind of a wake-up call for all of us. Mm-hmm. It also may be kind of like the canary in the coal mine for what's going to happen for retirement planning down the road. Okay. And so let's talk about this for a minute. So what happens when we have a whole bunch of debt like we do, and all of a sudden there's a little bit of what we're seeing right now at the current administration, right, where there's a little bit more nationalism. There's a little bit more, quote unquote, national, let's defend America first type concept. Now, the rest of the world is doing something very similarly. We're seeing Britain say, oh, this is for Britain first. And we're seeing even the French go, oh, this is for us. We should be French again. Yes, let's make French. Yes, that have nothing to do with French fries. Yeah, whatever it is. So we're seeing this from the Emirati and the UAE across the board. And what does this mean? Two things. We've been watching bond auctions fail spectacularly. Spectacular. One of the more recent bond auctions in May. Now, this is where the government goes out there and says, hey, we're going to issue some 20-year notes. We're going to basically get a loan from whoever buys these bonds for the next 20 years. Now, what we saw in May, this was the lowest participation we've ever had in years. And not only that, the yields jumped. They spiked. This is a big deal, right? So not only did that mean that the government had to pay higher rates of return because fewer people wanted them, we have seen foreign countries buy about 50 billion less dollars of it, which is huge. That's huge. So when you think about foreign investors, they typically buy about 65% of all the bonds that we issue, right?
Okay.
And why did they do that? Well, because historically the U.S. paid their debts. Hey, we pay people back. We've actually never, the United States government to date has yet to fail making a interest payment or a principal payment back to any investor.
Okay.
Period. We are one of the only countries that have ever done that. And historically, that's why a lot of other countries are like, hey, we'll invest in America, right? I don't know if we want to buy their stock market, but we'll buy the bonds, we'll buy the debt. Okay. So what happened though is that with that fewer people taking advantage, here's what it's kind of like. I'm going to break it down for a second. The U.S. government had to offer more money for other people to buy its bonds, including other countries. This is kind of like if you have your credit card and all of a sudden the credit card company gets a little worried. Gets a little worried that you may not be able to make that next bill. Maybe they found out that you got laid off. Maybe they found out you get a demotion or you're not going to have as much money coming in or heck, you got a new baby on the way. And it's like, oh man, this guy's going to be strapped. Here's what we're going to do. We're going to cut his credit line down and we're going to make him charge more. We're going to charge him more interest. Think about it, guys. Think about that for a second. All of a sudden you need some debt. You need some. You got a baby coming. So anything like that. Mm-hmm. And all of a sudden they're going to cut your credit limit, which means they're just not participating. And they're going to raise the cost for you. Does that sound like a good situation? Mm-mm. No, it's a terrible situation, especially when most of these auctions are 10, 15, 20-year treasury bonds. Now, what do most pensions in America own?
Tell me.
A tremendous amount of 10, 15, and 20-year American treasuries. Really? Tons of them. And not just American pensions, but the rest of the world too. Because again, we're the only guys, or one of the few groups, that have actually paid all their bills until now. So now we're at this point where we have so much debt as a nation that it's starting to get, they call it in golf, they call it a dormie. A dormie means that you physically cannot shoot low enough on the next 3 holes, let's say, to have a chance to win the tournament. You can't. Game is already over. So here we are. It's not like we're at the 18th hole, still maintaining that golf idea. We have a lot of holes to go, but there's no chance we can win. And that's what the rest of the world is seeing. So when most of us are looking at our pensions, but also our retirement portfolios, if you have a diversified portfolio, there's a good chance you got bonds in there. Well, guess what? Almost every one of those high quality, I'm using air quotes, high quality bond funds has in there a good amount of government debt. So guys, this is very uncomfortable. Now, for those of us that are thinking, hey, if I want to retire next year, the year after, or the next 3 years, or here's part number 2, I just want to be retired over the next 20 years, right? Yeah. So it's not about, it doesn't matter if we've already gotten to that retirement line. Let's say over the next 20 years, what does that mean? It means that we might want to reposition some of those bonds or some of that government debt in the event that something bad happens. Now, what does something bad mean? We have to renegotiate that debt. What does that mean? It means those bonds may not give you back possibly every single dollar you put in. Now, would that be devastating to this country? Without question. But having said that, we are one of the few nations that haven't had to do this. More recently, I mean, even in the last 40 years, we've seen it happen to Mexico. We've seen it happen to Portugal. We've seen it happen to Greece. We've seen it happen to so many big countries, Spain, Germany, France. All these countries have had to reconstitute their debt. And we have more debt than almost anyone else out there, at least as far as what's owned by other people. So when we're thinking about retirement and what does this mean that we're not seeing very good auctions for bonds, this is, to me, a huge wake-up call about our investment portfolios. Okay. We may need to look for alternatives completely when it comes to the fixed income portions of our portfolio. It's
alternatives to bonds, which is traditionally what that 40 is in the traditional 60-40 model.
Absolutely.
Not always, but for the most part, the 60-40 model is 60% stocks, 40% bonds. Those bonds are your safety. That's your safe investments. That's the traditional model. That's not what we're saying it is.
Sure.
All right. So let's talk alternatives then, because the thing that I was talking about when I was saying I'm going to open up this can of worms, why would anybody just based on the debt and the taxes and everything that we as consumers see happening every single day, why would anybody, especially an American person who wants to retire soon, why would anybody invest in a bond right now?
Well, here's the problem. The problem is that yields are as high as we've seen in 30 years. So because of that, people are going, hey, John, I understand that you say maybe bonds may not be the greatest thing out there right now. But having said that, man, I can get 6% for those 20 years, as a matter of fact.
Interesting, yeah.
Yeah. So we actually have seen the 15-year spike up to nearly 7%.
Okay.
That is a decent amount of money. Now, here's my bigger fear. If it does not have a COLA allowance on it, which is a cost of living adjustment. And what happens if we do continue to have inflation? The president wants them to reduce rates. That's probably not super wise right now because we still have a lot of inflation out there, right? Okay. So when you look at that, what would happen if it doesn't have a cost of living allowance? Well, that means that 7% you're getting now, what happens if the rates go up to 10 or 11 or 12? See, that would not be very good. As a matter of fact, you'd be losing money on that deal, right? So the thing to understand is there are alternatives out there that are good. And I've also heard tons of people say, well, John, I don't have any government debt. I have other bonds that's not government debt. Well, if you look at almost any debt, most of it is either attached or collateralized by something. For the United States debt, it's our ability to tax us and pay back those loans, right? When it comes to most things, they're secured by mortgage collateral. Now, imagine what happens if interest rates go up and not down to the value of every building out there. People cannot afford to pay you the going price for that real estate. Let's say you have a $500,000 house, but and you bought it when interest rates were 3%. Good deal. Great. And because of that $500,000 house is worth it. Now, what happens though if interest rates go from 3% to 8%? Ooh, someone cannot afford to pay you $500,000 for that house because their monthly mortgage would be way too high. They can only afford to give you $400,000 for that house. That's how it works. That's how we see it, right? If we have a credit card that's got a 28% annual rate, hopefully we can cut that sucker up and get it out of our wallet. But we know for a fact, even if we can't get rid of it, that's the one we want to use last. That's not the one that we want to use all the time, right? Because it's way too much debt. We'd have to pay way too much debt service to maintain that. Right. So when we think about that, all that real estate debt out there, if interest rates stay high, real estate is not going to be as good of an investment either. So the two main things we can consider to divest into, number one, private credit can be very strong because often you can get an increasing interest rate if interest rates rise, which is very good. And you can look for some types of insured accounts like an annuity or something like that. And I know annuities get very polarizing views for every side of it. But think about it. What if you got a guaranteed payment that had a cost of living adjustment on there? So right now, if you're getting 6% and all of a sudden rates go up 3%, maybe you're getting close to 8% at that point in time. So those are considered longevity type annuities or things like that. And they're not built to be your only investment. Yeah. But again, if we've got money that's sitting in bonds, it could be substantially more attractive because the way that insurance companies operate, if done correctly, they have to reserve every single dollar you give them in a reserved account. They can't try to risk your principal. Okay. On fixed accounts. So those are the things you can consider. And are they perfect? Absolutely not. Right. But it's a lot better than losing a ton of money and a lot of sleep by being in bonds, maybe over the next 5 to 15 years.
Understanding what your opportunities are in every economic climate, in every market circumstance. That's the goal of every plan that they build at J. Hagan Capital. And John and his team here to show you what your opportunities might be as well. So if you are concerned about the rising debt, if you are concerned what it means when it comes to bond opportunities or the lack thereof, should we say, let's get to work addressing your concerns, understanding your concerns, and then building a plan to provide solutions. RetirementSolutionShow.com is where you can go to start the conversation with John and his team at J. Hagan Capital. We also have links posted in the show notes, so you can just click there to head to our website, which is, again, RetirementSolutionShow.com.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with John and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to John's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 188270094.